Peter Rose, Longwood Currency Trading. I want to talk to you a little bit about the title of the video is Forex Trade Entry Price Action Considerations, and talk a lot about trade entry, and a lot of the videos that I've done, well, all the videos and all the blog posts and everything else, has to do with making the risk management part simple by setting a static set pip amount for your risk. Then you don't even consider that in your trade entry. There's so much time wasted in analyzing trades when you put the risk part into the mix. I just simplify that by quantifying my risk and then getting on with it, because I'm more interested in how much the price is going to move toward my target than I am whether it's going to move toward my risk. I don't want to have to figure out my risk every trade. I don't. 2% of my bank. It has nothing to do with the price action. The structure of where that risk point should go means absolutely nothing, except if it goes there, you've waited too long and you're wrong. So I just quantify that and get it out of the way. I have a good win-to-loss ratio, and so I more than make up for a short price, a short risk point, getting hit by price and taking me out. Well, that's based on experience, and so how do you do that if you don't have experience? Well, you learn by your mistakes, as Jesse Livermore said. The only way to get an education in the market is to invest cash, track your trades, and learn from your mistakes. And so, in order to get that experience, you have to lose. You have to be willing to lose. So don't lose in a $40,000 account like I did and get wiped out. Learn in a $1,000 account, which is what I teach if somebody wants to learn from me. And then you make, at $1 a pip, you've got to lose 500 or 600 pips to bring the account down to whatever the margin level is. If you had a $1,000 account and the margin was $500, you'd have to lose 500 pips before you had to reload, right? So, it's really tough to lose 500 pips unless you're stupid. There's just no reason for that. So you learn it in a mini account. And if you do make a mistake, like you put a trade on, or you have a... Where's my dog? Bo! Come on, Bo. Come. My wife just left. She's heading up north to visit her aunt again, and left us in this beautiful New England foggy day, as you can see as we walk up the road here. My task was to take the dog again for for a walk in the woods. You got to take a poop, so you take the dog out for his daily thing in the woods. But the point of the video is talking about trade entry price action considerations, but having the need to preface that by saying that's not one of the many things that I have to do in order to determine whether I'm going to take a trade, because it's not. It's the only thing I have to do, because I'm not going to be worrying about the price action of risk. I'm going to quantify that, and I'm going to get rid of it. I'm looking at this birch tree here. That's why my gaze is coming over here behind the screen house, and that does not look like it would take a whole lot of wind or snow. I may have to see how the winter deals with that and then drop it down. Where's Bo? Hey, Bo! Bo! Where did you wander off to? There he comes. Where is he? Oh. Sorry for swinging the camera around. Another travelogue. Okay, Bo, come on. We're going to go down the trail here. Come on. Let's go. Come on. Go, 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 go. So in trade entry price action considerations, what you're really trying to determine, and the first thing that you do when you evaluate a trade, I wonder if I'm getting cut off on this thing. Let me just raise this up a little bit. the first thing you do when you're looking at the market, at your charts, is does the structure, does the price action have a reward target that's worth going after? If you had a 3 pip reward target, that wouldn't be worth going after. If you had a 5 pip reward target, that wouldn't be worth going after, because the chatter of the price, whether up on the daily chart or you're on the 5-second chart, you know, you're shooting for those small targets, and that's not any good. So in my instance, does the structure of what's going on provide me with at least 20 pips? And I'd like to see that there's some potential there for 30, but I'm realistically thinking that based on the ATR of the time frame that I'm trading on and the currency pair that I'm trading on, that 20 pips within a 15 or minute or somewhere in the 15-minute to 2-hour time frame, which is when I trade, that's a very reasonable target to hit. And I could hit that one time and it'll come back, and then price retracts, and I can trade in and out several times a day based on that. And I might not get the 20 pips, but I'll be getting parts of them. All right, Bo, let's walk on up here. We're going up the trail here. So the first thing that we have to look at in price action considerations is, first, is there some target that's worth shooting for? Is it there? Does it even exist? If it doesn't exist, then there wouldn't even be any point in talking about what kind of risk I'm going to take, right? So, you know, preliminary to determining if the reward is there, it has to be in the directional bias that the trend is currently in. And I've talked about how you determine what that directional bias is, what kind of time frame that you'd want to look at, because you use multiple time frame analysis when you do this kind of stuff. And so in my trading, the directional bias, I'm trading on the 5-minute chart, my directional bias might be 15 minutes sometimes, it might be an hour on other times. It just depends on what the price action considerations are when I go into that trade, when I'm ready to make that trade and I see that there's a potential there. What sort of price action is going on at that time? And then I determine, well, which chart should I use as my directional bias? I'm not interested in anything until I see that if price continued in its current direction, does it provide that 20 pips? If it doesn't provide the 20 pips, what the fuck do I care what the directional bias of the price is or anything else? You just look at the chart, boom, it's there. And if it's not there, what do? I'm going to sit there and I'm going to look at it and hope and pray that a trade appears? No, that's called an anticipatory trade. And I've done videos about that before. You should watch those videos. Hey, Bo, let's go down this way. Bo, let's go this way. Come on. We're going to go down the trail this way first. So again, the price action, the entry price, trade entry price action considerations involve all that sort of stuff. But that's all done, wait a minute, I got to get over this branch here. Come on, Bo. All that stuff is part of that intuitiveness that an experienced trader would do. You look at, oh yeah, I got a price target. What's the directional bias? You flip up to that chart, boom, yeah, okay, that's good. And you go through a checklist, a lot like an airline pilot is going to go through a checklist before they turn the engine on, or after they turn the engine on, before they pull the plane away from its parking spot, right? So there's a checklist of stuff. Now, for an airline pilot, wow, the water is... I've run into this stream here, which wasn't here the last 2 months because we've been in a drought and it's been really raining the last week or so, and the dog is gone again. Hey, Bo! Bo! Come on, Bo. You get lost in the woods. Come on. What are you doing? There's the Bo dog. He's dancing to his own tune today. I think he's done his business or whatever. I'm going to go back inside because it's foggy and damp, and I got a cup of coffee that's waiting for me back there. I'm going to run back and do this. Again, you get that intuitive experience or that intuition. It comes from experience, and you get the experience by simply making a lot of mistakes, as Livermore said, and you lose money. And you can't do it in a fucking demo account, because the losing of money in a demo account doesn't mean anything. You lose $10 or $20 on a $1,000 bank, that's going to sting you a little bit. Even though it's only a pizza, that $10 that's going to sting. If you start out on a $40,000 account like I did, then the losses there are significant, and they get your attention. But after I lost all that money and I wanted to go back and do it the right way, and I started out with I had a $5,000 account, and as I've said before, I doubled that in, I don't know, it was a little under 5 months once I figured out what was going on. And I said, well, and then I was still doing some stupid shit, so I said, well, let me drop down onto the $1,000 account and just trade for $1 a pip, because then I can make these mistakes and I can kind of see really what I shouldn't be doing. I mean, I'm following Livermore's thing. And, you know, I lost a couple of those $1,000 accounts because there's a lot of conflict with how you really trade with what the best practices or all the other educational resources are trying to tell you how to do it. They're just having it isn't that they don't know how to trade, it's that they have a hard time expressing in words what they do intuitively, and so they have to rely on stupid shit like indicators or patterns or all this other crap that any institutional trader who does this shit for a living will tell you is bullshit. So that's why when I teach currency trading, I don't teach indicators. I show a few indicators, I give you some exercises, and the thing is, you're going to see that they don't work. Well, now you know what doesn't work. Now what does work? How do you go from there? Well, what's the biggest fear we have? We have the fear of loss, isn't it? You don't want to lose our money, and so you get fixated on setting this risk point. And that's stupid. Take that out. Take it out of the equation. It's 8 pips, because when I teach somebody, I teach them on that 5-minute chart. And then after they get done with me, they can go up and trade on a daily chart for all I care, because what I'm teaching is translatable up onto the higher time frames. If you learn to trade on the higher time frames, you can't translate that back down onto the shorter time frames. I've gone over that before. Hey, Bo, we're going to go this way. Bo, go, Bo, come on. Bo. Hey, Bo. Notice how obedient he is. He's smarter than I am. These are mini Australian Shepherds. Oh yeah, they're smart. He's just playing dumb because he doesn't want to come down this way. Come on, we're going this way. Come on, come. I'm out here in the fog walking him, and he doesn't care. There he goes. See? He's heading for the door. So you take that stuff out of the reference frame of your trade analysis, and what are you left with? You have a profit target, and everything else has been resolved. So the question then is, how do you make the actual price entry decision? When do you do that? You know what to do, and you know how to do it. But when do you do it? That's the whole point of this video. And unfortunately, that's an experiential thing. But things that are experiential have to be backed up in reality and in fact. I mean, you can talk about the Heisenberg uncertainty principle in physics, which is a very theoretical thing, but it has descriptive mathematics that not only describe it, but also point you to physical phenomena that are going on in the universe that validate that particular principle, okay? And so it's got to be with trading. Trading is just another process of us intermingling our spiritual selves with the nature around us, and that particular game happens to be called currency trading for us. Could be sailing, it could be backgammon, it could be badminton, could be gardening, could be anything. This is all rule-based and supported by rules anyway. But the rules themselves, the what and the how, are not all that's needed. You can't plant a garden just because you know what to plant and how to plant it, because if you try to plant it in the middle of the winter, it isn't going to work. I mean, this is just really basic stuff, but nobody out there in the educational world is talking about stuff like this, because it's boring to sit here and listen to somebody rant on about this stuff when really what you want to see is some fool trading on a chart live and showing you how he made his 20 pips for the day. But that doesn't mean that you can do it, and he's not teaching you anything. Well, you have to learn it. You have to invest your cash, track your trades, and learn from your mistakes. That's the way you got to do it. So how do you then take this ephemeral concept of trade entry considerations of, I've got this 20 pip profit target, but what do I do with that? When do I fire the gun? What are the rules? And see, there are no rules specifically. If I gave you a rule and you followed the rules, you wouldn't be successful. You know, Richard Dennis, who taught the turtle traders, and Curtis Faith, who made $30 million in 4 years, in the 4 years that he was part of the turtle program, for Richard Dennis. They got 2 weeks of trading, and then they had a month because none of them had traded before, to learn the trading process and how to put the trades in, and just generally how to do it. And then he gave them somewhere between $200,000 and $2 million to trade after a month of live money. And he said, I could publish those rules and no one would follow them. The only reason those people were successful was because they had a guy, and this is from Curtis Faith's viewpoint. He said, I have a guy leaning over my shoulder telling me to hit the bid, and I'm scared to death, but I got a guy that's worth $200 million that turned a $400 initial stake into $200 million telling me to hit the bid. Do you think I'm going to sit there and argue with him, or do you think I'm going to sit there and feel sorry for myself and clench my hands in fear? I'm going to hit the fucking bid. So how do you make that transition between a set of rules and the actual activity of successfully implementing those rules? The solution that I propose in this is a discussion of what I call the momentum. Other people might call it volatility, but I think from a physicist standpoint, volatility and momentum are two totally different things and need to be addressed in two totally different ways. And so this video is only to bring us to the point of saying, eliminate all the other clutter of the trading that you might have studied or been involved in, and let's focus on, you've got this profit target. Now, how are you going to determine that price could get there? And that's going to be based on the momentum of that candle, or that price, which is represented as a candle. A series of transactions is a candle. So how is momentum manifest? Momentum in physics is mass times velocity. That's momentum. Well, the mass is the orders. That's an order against that market. That's the mass. And the velocity is the rapidity, the rapidness of the number of orders that come in. So you've got a mass and you've got a velocity. And in physics, we say that the velocity is a vector quantity. Momentum is a vector quantity. A vector means that you have a magnitude and you have a direction. So the direction is the directional bias that the traders are moving price in, and the magnitude of that vector is how many orders are hitting that to cause that to happen. It's a supply-demand thing. There's a lot of people that say that currency trading is not supply-demand. It is supply-demand. That's what gives you the juice. If you didn't have any supply-demand, it wouldn't be there. So that momentum is going to be based on the order flow. The order flow directly affects the size of the candle. You have an ATR that's based on, from all practical purposes, is 14 periods of whatever time frame you're on. So if I'm on a 1 minute time frame and the ATR is 2 pips, then I'm looking back over 14 1 minute periods, and that's giving me a 2 pip ATR. If I'm on a daily chart, right now the currency pair that I trade has a daily ATR of about 120 pips. And that's considerably bit different right now than the 80 pip ATR that it had a couple of months ago. So these things change, and so you have to be able to take the general nature of the price action that's occurring overall in that price, because you're trading in a finite time frame of that price action. You're trading in a 1 hour period of time, or you're looking at the price over a 5 hour period of time. You're not looking at price at 3 a.m. And as far as I'm concerned, if you have carry trades that you have stops put, that's long-term trading. I'm not going to do that because I don't want to go through the night not in control of my risk. You can do what's called OCO trades, order cancels order, where if a certain event happens, then you change the standing orders that you have. If price gets to here, you do this thing, and if that thing happens, then you do this thing. It's that type of if-then-else scenario that your trading platform, many of them can have. But if they don't, or you don't know how to do that, then you better be up at 3 a.m. watching that trade. Or you better have a high enough profit target so that your risk is really wide to give that price room to what they call breathe. I'm not going to give my price time to fucking breathe at all. I think that's the stupidest thing in the world that anybody could say. My God. What am I going to do? I'm going to start walking out on the ice, and I'm going to wait until it actually breaks before I realize that it's not there. I'm going to walk out on the ice as far as I can start to sense that it starts. You can hear it, or you can see water 40 feet in front of you. Why would I walk out 30 feet to see if the ice is strong enough so I don't fall in the water? I'm fine at 10 feet. That's it. I'll go 10 feet. And if it doesn't crack, that's fine. I'm out at 10 feet. I'm not going any further than 10 feet. I'm not going to take that risk. So the momentum has got to be, you got to have something that you can relate that to. So the ATR is a demonstration of the magnitude of the movement of that candle over the past 14 periods. So if you see the magnitude of that ATR, the magnitude, of that candle increasing above the ATR, and I'm not saying whether it's the ATR of the current chart or the ATR of the higher chart. I do it in a certain way, and I'm not going to get into it here because that just complicates the discussion. But what the discussion is on momentum, price action, trade entry, price action considerations. This is it, boys and girls. It's called momentum. Basically, when the magnitude of the candle increases in relationship to the underlying ATR by a certain percentage, then you have to figure that that price has the juju to go on in that direction. Now, how much further it's going to go on is the differential between the size of that candle and the underlying ATR. But if you wait too long, then those size increases in the candles changes the underlying ATR. Oh my God. Well, I have a way that I deal with that, and it works really well because you want a static ATR to compare the candle size changes on. So there's something else that you have to do. Well, that's immaterial to the discussion. In order for you to determine when you should enter the trade, is that you have to be able to have some sort of metric that enables you to say that price has the momentum to continue on in that direction for 10 pips, 20 pips, or 200 pips, whatever profit target that you're looking at. So if you're on a long-term chart, you may be looking at a 200 pip profit target instead of a 20 pip profit target. Well, that's fine, but your risk is going to be 100 pips or 50 pips or whatever it is, and so that price then has the room to breathe, and you need that room to breathe in order to go for that 200 pip profit target. So you just need to figure out how to proportionally structure where you're going to get out if the thing starts to turn and go against you. I mean, the guys that are really trading that set up this risk to reward ratio, and the price is going up and it's floating around and then it starts to come back down, they don't wait. Believe me, they do not wait until that risk point is hit before they get out. If they do, well, they probably won't be doing videos or writing books because they're not going to make any money. Because you can't take those types of hits and count on making the money. There's no guarantee that that price is going to ever hit that profit target. You could hit swing points, all kinds of differential things can happen. News could come out and it'll never move in that direction. So that's why I find it difficult to trade on a longer term chart, because there's so many other decisions that need to be made. Your risk needs to be recalculated, your profit points need to be recalculated. Everything needs to be constantly monitored because you're in there for a long time. As Tommy Lee said at one point in life, we're not here for a long time, we're here for a good time. I'm not in the trade for a long time, I'm in the trade to make money. And if I can make 5 pips, I'm going to take that. If I can make 25 pips, I'll wait and then I'll take that. But it's got to be moving in my direction. It's got to be doing something that is according to what I thought it was going to do. Because if it goes in the wrong direction, then what I thought was going to happen didn't, and I should get out right away. Why would I wait? I can always get back in. So it comes down to a process of judging the momentum of price action at any given time throughout the period of the trade that you're in, that determines not only does it have the magic juju to get to the profit target, but once it's en route to that profit target, what is the likelihood, what is the probability that it will continue in that direction and be able to achieve that particular profit target or beyond. And so just eliminate all the other choices and all the other decisions. Just work on trying to understand price momentum. You know, I did another video called Close Trades When Price Momentum Changes. You might be interested in taking a look at that video as well. And I think I did a blog post on that. I'm not real sure. I tend not to go one for one on blog posts and on the videos, simply because one medium is better expressed both ways. Like when I did the probabilistic analysis, I did a blog post on that, and I did a video. So the video had a different approach and a different view of that than I was able to do more analytically in the blog post. So you know, you just have to, if you're looking at my stuff as a body of work, you just have to bear that in mind. But you might be interested in my video, Close Trades When Price Momentum Changes, because that gives you an idea of how I'm looking at that price momentum as the price is moving on toward the profit target that I've set out for myself. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.